Hello and welcome back to the ERM Advantage Podcast. I'm Eric Holmquist. So today we're going to do something fun. In the past weeks, I've really enjoyed having some amazing guests here in studio to talk about different areas around financial services and risk management, all that. But today we're going to do something a little bit fun, and I've been thinking about doing this for a while now. And I'm going to have a conversation with AI, and I'm going to ask AI about banking and risk management, all of that, and we'll see what it has to say. Obviously, AI is something that we're seeing, every institution considering, how to use and how they can use it. And I wanted to talk to AI and find out, what it would say about these topics. So since we know that AI, can give us great, terrific answers, but can also hallucinate a little bit, let's say we'll consider this for entertainment purposes only, but let's see if we can get some little nuggets along the way. So I'd like to have a conversation about banking, and I'd like you to act as an advisor and subject matter expert on the banking industry and environment, banking strategy, and how banks should be thinking about both opportunities and risks going forward. I'd like your insights based on your best information available, so it's okay if you don't always have an answer to a question, but I'd like to see from what you do know what we might be able to learn about banking. Sound good?
That sounds like a productive conversation. I'll provide clear strategic insights grounded in what's known about banking industry dynamics. If we hit areas where specifics depend on current events, I'll let you know. Let's get into it. What aspect of banking strategy or risk are you interested in evaluating first?
All right, so let's start off in general. What would you say makes a good banking relationship? If you want, feel free to differentiate between a typical consumer versus a commercial relationship.
A strong consumer banking relationship hinges on trust, accessibility, and personalized service. Customers expect seamless digital interfaces, transparent pricing, and supporting key life moments like mortgages or savings goals. For commercial relationships, the foundation is far more consultative and tailored. Businesses rely on their bank for credit structuring, risk management advice, and tailored financial products. Proactive relationship management, understanding a client's industry, anticipating financial needs, and being a strategic partner define success. Both models, though, depend on long-term value creation, not just transactional efficiency.
I agree. So what would typically motivate someone to decide to change banks? How much of that decision is based on product, services, trust, or loss of it, convenience, pricing, or life stage?
Switching banks is usually driven by a mix of triggers. For consumers, convenience, like poor digital experiences or price changes. Fees or rates often prompt moves. Loss of trust, e.g. a dispute or poor service, can be a decisive factor. Additionally, life stage changes, e.g. home buying, may require products their current bank doesn't offer competitively. For businesses, key factors include access to better credit terms, industry expertise, or if they feel their bank no longer anticipates their strategic needs. Ultimately, perceived value in the relationship is pivotal in both contexts.
So what factors would generally be the most influential in the decision to choose one bank over another?
In a consumer context, digital capabilities are increasingly decisive. Intuitive mobile apps, seamless payments, and frictionless account management. Also, competitive pricing. Interest rates, fees, and rewards shapes choices. Trust and reputation still matter. People look for stability and security, often preferring well-known institutions. For businesses, the decision is more complex. Credit availability, tailored financial solutions, industry expertise, and relationship management are paramount. A bank that demonstrates an understanding of a business's specific needs, from cash flow to risk mitigation, will be a standout choice. In both segments, relationship quality, the sense of being valued and understood, remains a tiebreaker.
See, this is great, and this really underscores, what I covered in the very first podcast where I talked about the real sort of value proposition with banks. And what I talked about in that is that a bank's true asset, their real crown jewels, is trust. Offering many of the products are commoditized, but what really differentiates a bank is that trust relationship. So I love the fact that was central to that. It also sort of emphasized the idea of being kind of proactive and looking at their needs, but we're going to sort of tease that out a bit more. So let's talk a bit about kind of the environment. What are potential regulatory changes that banks should be aware of and paying attention to?
There are several regulatory changes for banks to watch this year. First, capital requirements are being reduced under the Basel III Endgame, lowering thresholds for large and small banks alike. Second, there are new rules targeting stablecoin issuers and fintech partnerships, so banks with such relationships will need to ensure compliance. Finally, regulatory focus is also tightening on cybersecurity, AI model governance, and fair lending data, so banks should strengthen risk management in these areas. Overall, these changes may ease capital burdens while increasing oversight on technology and partnerships.
And obviously, we don't really know yet, but how might regulators be thinking about new regulations around things like AI and digital currencies?
Regulators are likely approaching AI with a dual focus, ensuring ethical use and managing systemic risk. They may emphasize AI model explainability, fairness in lending decisions, and preventing bias. Governance frameworks will likely require robust auditing, stress testing, and transparency in automated decision making. With digital currencies, whether stablecoins or central bank digital currencies, regulators are prioritizing financial stability and consumer protection. Expect rigorous requirements on reserves, capital, KYC AML compliance, and interoperability. In both cases, regulators aim to balance innovation with stability, ensuring new technologies don't amplify systemic vulnerabilities. Banks engaged in either will need proactive compliance strategies.
So I know there's a lot of factors that influence our economy, but when might we face the next major economic downturn?
Current economic forecasts suggest global growth around 3.1% in 2026, with a U.S. recession risk estimated between 30 to nearly 50% depending on conditions. The main risks involve prolonged high oil prices, weaker consumer spending, and geopolitical uncertainties. While some foresee a mild to moderate recession, a severe crash is not broadly expected, but it's wise for banks and businesses to stress test for economic volatility later in 2026.
So, what would you say are the largest external threats to traditional banks right now?
The most significant external threats come from both the macroeconomic environment and disruptive competition. First, macroeconomic volatility, such as inflation, interest rate fluctuations, or geopolitical shocks, can destabilize balance sheets. Second, big tech and fintech firms continue to erode market share, offering faster innovation and often lower costs. Third, cybersecurity threats and data breaches pose existential risks, both financially and reputationally. Finally, regulatory changes, like new capital rules or climate-related disclosures, can pressure margins. Banks must navigate all these vectors simultaneously, necessitating adaptable strategies.
What could you see as some potential new novel, financial crime methods, risks, or cybercrime, methods or risks?
As technology evolves, I'd expect more sophisticated attacks leveraging AI. Deepfake fraud, voice or video impersonation of executives could be a major risk for high-value wire fraud. AI could also enhance phishing attacks, making them more personalized and convincing. On the digital asset side, smart contract vulnerabilities in decentralized finance could be exploited for major theft. Also, quantum computing, once feasible, could threaten encryption if banks aren't prepared. Overall, financial crime will likely become more automated, complex, and tech-driven, necessitating equally advanced, proactive defenses.
Banks focus a lot on data, and obviously we talked briefly about the security side of it. But data governance has become a big area as institutions look to utilize their data more effectively. So what would you say are some best practices around data governance?
First, banks need clear data ownership, defining who is accountable for data quality and security across the lifecycle. Second, comprehensive data cataloging, Knowing what data you hold, its sensitivity, and how it's used is essential. Third, robust access controls, limiting who can access what data and ensuring appropriate permissions mitigate risk. Fourth, data lineage tracking, documenting data origin, transformations, and usage ensures transparency. Fifth, a strong data ethics framework, ensuring data is used in fair, compliant, and customer-centric ways is critical. Finally, regular audits and continuous monitoring ensure ongoing compliance and responsiveness to new threats or regulations. This holistic approach maximizes both security and data value.
See, I really like where the A is coming from. She highlighted a couple of really key areas, and particularly as it relates to different areas of fraud. I think we're going to see some really novel methods where AI is going to be used around, fraud methods of identity theft and creating synthetic profiles that could be used to commit fraud. So I think that is absolutely spot on. So what's interesting is obviously these questions are very broad, but you could dial these in further. And this is where I think there's a really interesting use of AI because, these answers are very appropriate. I agree with those. Nothing stood out that I thought was wrong, but they were also broad brushstrokes. And I think there's a fair number of those questions where, you'd want to take them and you'd want to dial them in more for, say, your company, based on your size, your complexity, your focus. I think there's questions you could say, okay, now let's look at our institution and consider some of the specifics about our environment and relook at those again in terms of various risks. So that we're off to a solid foundation. I think those are some good sort of entry-level questions just to sort of give us a reasonableness check, and I like what I'm seeing. So now we're going to drill into much more strategic questions as well as some areas of specific application. So this is good stuff. So let's talk a little bit about strategy and strategic planning and opportunities and all that. So right now, what should banks be considering as part of their strategic planning?
Banks should be evaluating digital transformation as foundational. This means not just offering digital products, but rethinking processes end to end, leveraging data analytics for hyper-personalization, and ensuring seamless omni-channel experiences. Next, they must consider partnerships, whether with fintechs or other sectors, to expand capabilities, particularly in open banking or embedded finance. Sustainability is another pillar, integrating DSG, environmental, social, and governance, principles into lending policies, operations, and reporting. Additionally, a proactive approach to regulatory change, anticipating shifts in capital requirements, digital assets, or data privacy is critical. Finally, talent strategy must be on the agenda, attracting and upskilling people who can navigate both technology and evolving customer expectations.
So of the various products and services that a typical financial institution offers, which of those tend to be the most profitable?
Typically, net interest income from lending products, especially mortgages, commercial loans, and consumer credit, drives the bulk of profitability, since the margin between loan interest earned and deposit interest paid is substantial. Wealth management and investment services also yield high margins, given advisory fees and asset-based pricing. Payment services, including credit cards and merchant acquiring, generate consistent fee income. In contrast, low-fee deposit accounts and commoditized products are less lucrative. Thus, banks strategically emphasize lending and advisory services to enhance profitability.
So beyond everyday checking, savings, and loan products that banks typically offer, are there other products or services that they should be thinking about offering that might be novel or appealing or may take advantage of technological capabilities or may simply be unique from what every other bank tends to offer?
Banks can leverage embedded finance, integrating banking services directly into non-financial platforms. For example, offering payment or credit solutions within e-commerce or software platforms. Another frontier is digital assets. Custodial services for cryptocurrency, tokenized assets, or stablecoin payments. Personalized financial wellness tools, such as automated savings, micro-investing, or budgeting AI, offer differentiation. Banks can also explore green finance, tailored lending or investment products for sustainability-focused clients. Finally, offering advanced cybersecurity and fraud prevention as a premium service can appeal to high net worth or business clients. In short, differentiation will come from embedding, personalizing, and leveraging emerging tech.
So what would you say that banks tend to spend too much time on, and where are they not spending enough of their time?
Banks often spend excessive time on legacy systems maintenance, keeping old infrastructure running, and on compliance processes that, while necessary, are often executed in highly manual, rigid ways.
Yes! Yes! Oh, yeah!
Additionally, they may focus disproportionately on product pushing rather than deep customer insight.
Yes! Yes! Yes!
On the flip side, they often underinvest time in strategic innovation, anticipating future customer needs, or in holistic data strategies, where data is fully leveraged for personalization or efficiency. They also don't spend enough time on cultural transformation, ensuring staff embrace a proactive, agile mindset that aligns with modern customer demands and technological advancements.
So I swear that this agent was not trained on my podcast, because those were things in there that I've specifically called out that I think really are key to kind of the next gen of banking. Much more proactive services, better data management, anticipating needs. So at least AI thinks I'm heading in the right direction. I think it's also absolutely right that banks tend to spend too much time on legacy stuff that at some point you just have to say, we just have to move on to that's old systems, old processes, being able to say out with the old, in with the new. So I like where she's going here, and I think those are spot on in terms of kind of thinking strategically. Historically, banks do have trouble differentiating themselves from their competition. Most offer the same products and services, and so most will promote their great service. But that really isn't much of a differentiator. Now, you mentioned some possibilities, but are there any other ways that a bank could really differentiate itself from all the competition in a way that a customer would really see as adding value?
Differentiation could be achieved through hyper-personalization, leveraging data and AI to offer tailored advice, custom financial plans, and predictive insights unique to each customer's goals. Alternatively, banks could differentiate via embedded finance, seamlessly integrating their services into the platforms customers use daily, e.g., retail apps, accounting tools, or e-commerce ecosystems. Another approach is sustainability leadership, being a true ESG innovator, offering green loans, carbon tracking tools, or impact-aligned portfolios. Finally, banks can distinguish themselves via community-centric models, hyperlocal initiatives, partnerships, and financial wellness programs that show deep, authentic community engagement. All of these elevate perceived value beyond baseline products.
What strategic bets should regional or community banks be making right now to stay relevant?
Regional and community banks should prioritize deep local integration, becoming embedded in the economic fabric of their communities through partnerships with local businesses, tailored lending programs, and financial education initiatives. They should also invest in niche expertise, specializing in specific industries or segments like healthcare, agriculture, or small businesses, where they can provide specialized advisory and financial products. Digital transformation is key. They need modern, user-friendly digital interfaces to compete with larger banks. Finally, they should bet on relationship banking, retaining a human-centric, high-touch approach that larger institutions often struggle to replicate.
Once again, I couldn't agree more. So this is kind of exciting that we're not getting sort of, out in left field type answers. But I think a couple of those points were absolutely spot on. The idea of being again, hyper, centric, hyper local. I think that has a lot of merit. The idea of focusing on a niche is that's gold. That is absolutely advice gold. One of the best ways to differentiate is find a specialty niche that you can focus on and master and become known for. And then certainly being able to master digital. Obviously, institutions have been working on this for some time, but there's more to be done. And that whole relationship thing, I think, is key, is really, focusing on the relationship, and that goes along hand in hand with the predictability aspect. So now we're going to talk about physical locations and some basic kind of blocking and tackling type stuff. So let's talk about kind of physical infrastructure, notably locations. So if a bank is going to build new branches, given the decreasing demand for branch usage, what's really the optimal model for a new location? A full service branch, a small footprint location with limited services, in-store kiosks, etc.
The optimal branch model is a hybrid that aligns with evolving customer behaviors. For dense urban areas, small format advisory hubs, focusing on complex services like mortgages or investments, offer differentiation without costly footprints. In suburban or rural zones, a smart branch concept, small spaces with assisted self-service tech for routine tasks, while staff focus on high-value consultations, balances efficiency and engagement. In retail-heavy areas, in-store kiosks or micro branches, staffed minimally, focused on quick transactions, capture foot traffic. Across all, seamless integration with digital channels ensures customers feel their needs are met, whether in person or virtually.
So it sounds like there's no one size fits all. It's an it depends based on a number of factors.
Precisely. The optimal approach depends on demographics, local market dynamics, and the bank's strategic objectives. Each location type should be designed to maximize efficiency while aligning with how the target customers prefer to engage, whether digitally, in person, or in a hybrid manner. Strategic location planning is about balancing cost, convenience, and customer experience.
So let's talk about that. If a bank is thinking about expansion, either by building new branches in an area where they don't have a presence, or more virtually, well beyond their physical footprint, is one model preferential to the other?
Certainly, the optimal model depends on both the local market and the target customer base. Full service branches can be strategically placed in high traffic or affluent areas where complex advisory services are key. Meanwhile, smaller footprint branches or limited service hubs, like advisory centers or digital kiosks, can meet simpler transactional needs in urban or retail settings. In other words, the branch network should be a hybrid, deploying full service when in-depth services are valued, but relying on lean, tech-enabled locations for everyday convenience.
So how should banks think about expansion, either by building new branches in areas where they don't have a presence, or more virtually well beyond their physical footprint?
Banks should approach expansion as a strategic resource allocation problem. For physical branches, they should use data-driven market analysis, demographics, economic potential, and competition to identify high opportunity areas. However, they must keep capital efficiency in mind, given declining foot traffic. Virtually, banks can expand through strong digital platforms, offering seamless remote account opening, digital advisory, and robust self-service tools. Ultimately, expansion, physical or virtual, should align with the bank's core value proposition and target customer segment.
So then you're saying it may make sense, if you're exploring or thinking about entering in a new physical location, to expand there virtually first before actually putting stakes in the ground.
Exactly. Testing a new market virtually allows a bank to gauge demand, build brand presence, and refine customer acquisition tactics with minimal physical overhead. If digital penetration and customer engagement show promise, then a physical presence can be introduced strategically, with a clearer sense of where a branch would add value, often as a complement to digital rather than the starting point. This reduces risk and ensures smarter capital deployment.
So let's talk about a couple of kind of practical application areas. So the bank is thinking about beginning to launch a instant payment product for their customers. What are the things that they should be thinking about, and what are the key risks?
First, they must prioritize real-time fraud detection and security, as instant payments attract heightened fraud risks. Second, regulatory compliance, both local and cross-border, must be rigorously addressed. Third, they need robust infrastructure to handle instant settlement, both in terms of uptime and scalability. Fourth, customer experience must be seamless, ensuring intuitive interfaces and clear user communication. Fifth, interoperability with other payment systems is crucial for adoption. Finally, they must have a clear revenue model, whether through transaction fees, value-added services, or strategic partnerships, to ensure sustainability.
So, are there any areas where banks in general could do a better job, whether related to offerings, customer service, delivery, etc.?
Banks could improve by streamlining customer onboarding and verification, reducing friction while maintaining compliance. They can also do more in personalized financial guidance, leveraging customer data to offer tailored advice, not just products. Additionally, seamless omnichannel experiences remain a gap, ensuring customers can move effortlessly between digital and in-person channels. Finally, proactive financial health monitoring, alerting customers to risks or opportunities, could transform the bank-customer relationship into a more trusted partnership.
See, and that's funny because this is exactly what I talked about in my earlier podcast episode. It really aligns with that idea of not just reacting to what customers need, but being more predictive, more forward thinking, and using data more to be able to anticipate customers' needs, as opposed to, again, just reacting to what they need. I think really the goal here is, being able to offer services that you've really thought through, and not just looking to push product, but again, it reinforces that idea of the relationship and working on the relationship. So let's talk a little bit about sort of the future of banking. Could you break down how a stablecoin would likely be introduced into the U.S. Financial ecosystem, the adoption curve, any threat to fiat, etc.?
A regulated stablecoin would likely emerge via trusted financial institutions partnering with or issuing it under oversight, ensuring reserves back each token. Initial adoption would be gradual, starting with fintechs and institutional use cases like settlements or cross-border payments, then expanding to retail use. Consumer adoption depends on trust, usability, and tangible benefits, like low-cost transactions. There's minimal existential threat to fiat currency, as stablecoins mirror fiat value. The primary risk is systemic. Regulatory gaps could destabilize financial systems if stablecoins scale without proper controls.
So how should banks be thinking about stablecoins, tokenization, and real-time payments from both a strategic and a risk standpoint?
Strategically, banks should view stablecoins and tokenization as potential extensions of their payments infrastructure, offering faster, programmable, and potentially cheaper transactions. They should evaluate partnerships with compliant issuers or consider their own offerings. Real-time payments should be integrated into core systems to meet customer expectations. From a risk perspective, banks need to manage regulatory uncertainty, ensure underlying reserves for stablecoins, and maintain robust cybersecurity. They should also monitor liquidity risks and ensure that any innovation aligns with trust in the banking sector.
So, what parts of banking would you say are most vulnerable to fintech disruption, and what parts remain really defensible?
Standardized, commoditized services like basic payments, consumer loans, and simple deposits are most vulnerable to fintech disruption, as fintechs excel at convenience and user experience. Conversely, areas requiring deep regulatory expertise, complex risk management, or relationship-driven advisory, like corporate banking, regulatory compliance, or large-scale lending, remain defensible. Also, trust-heavy segments, such as wealth management and long-term relationship banking, are harder for fintechs to fully replicate.
So, are traditional banks likely to be supplanted at some point by more fintech companies in the future, or will they always have a place in the banking system?
Traditional banks will retain a place, but their role will evolve. Regulatory infrastructure, trust, and large balance sheets are not easily replicated by fintechs. However, banks that fail to modernize risk being disintermediated in certain areas. The future likely involves partnerships, banks leveraging fintech innovation, while fintechs leverage bank scale and compliance. In essence, banks won't vanish, but those that fail to adapt may become less central as standalone service providers.
If you were advising a bank CEO today, what would be your top 3 priorities?
First, I'd advise a relentless focus on digital transformation, ensuring core systems and customer journeys are fully modern, seamless, and scalable. Second, I'd emphasize a robust data strategy, turning data into actionable insights, both for personalization and risk management. Third, I'd stress talent and culture, fostering adaptability, tech fluency, and a customer-first mindset across the organization. In short, a future-ready bank is digitally capable, data-driven, and people-powered.
Boy, and I could not agree with those more. I think and you could unpack those in a whole variety of ways. I mean, I think that would be a good starting place, and then where you would start to unpack those would be layering in and again, kind of training an AI on the specifics of your institution and where are we strong, where are we weak, what are we good at, what do we think our customers want, and then fine-tuning some of those answers. But just fundamentally, from a top-level perspective, that's exactly where you want to be. I think that the idea of really getting the infrastructure right and this whole, scalability, adaptability, resiliency, that's really key. I mean, a lot of banking, let's just face it, is still based on some legacy technology that is not built for scalability. And so, a lot of institutions are having to look at their infrastructure and decide which systems are going to be able to adapt, along with them versus where they need to maybe think about change. The data thing, I've talked about that enough. You cannot talk enough about that. That to me is a central, critical core competency, is being able to really leverage data. And again, this is one where I think AI could be used in some very, very interesting ways. And then third, just the whole around talent and culture. I absolutely agree. Again, there's going to be increased competition for good, strong talent. But we're going to shift. I mean, it was a day when I needed good credit people or good finance people. And now we're going to need people that are more operational or more tech savvy, more social media savvy. So I think the skill set stack is evolving that we're going to need, but it's an area that we simply cannot lose sight of. All right, I want to talk about some specific areas where AI it is meaningful to the industry. So where do you think, or what do you think are ways that AI can help a financial institution?
AI can revolutionize risk management by enhancing fraud detection in real time through pattern recognition. It also boosts credit underwriting by analyzing vast data sets for more accurate scoring. AI enhances customer service through chatbots and personalized recommendations, deepens anti-money laundering by flagging anomalies, and improves operational efficiency by automating repetitive tasks. Finally, AI augments investment strategies, delivering predictive analytics for portfolio management. In all cases, governance and transparency must accompany AI deployment to ensure trust and fairness.
And I agree with those. Let's drill a bit deeper into kind of a specific use case. So let's say, how could a bank use AI to identify, say, a good new target location or locations? What information would you need to know about the bank, and then how would you go about identifying new target regions?
I'd start by knowing the bank's strategic goals, target demographics, preferred customer segments, retail, small businesses, and service model, full service, advisory, or digital. With that, AI would integrate diverse data, population growth, income levels, competitor density, digital usage trends, and transactional voids. AI models would identify high potential zones where unmet demand aligns with the bank's strengths. Ultimately, AI guides decisions by quantifying opportunity and risk, helping the bank pinpoint locations that optimize growth.
And I know there is information that's available on demographic information for a given area about what sort of saturation rates there are for other financial institutions. As an institution considers new locations, are there certain levels of saturation where it just might not make sense for them to explore that area? There's just too much concentration versus other areas that may not be as saturated.
Yes, saturation thresholds matter. If a market has an excessive ratio of branches per capita or a high density of similar institutions, particularly with strong incumbents, competing on the same offerings can yield diminishing returns. Banks might set internal thresholds, such as market share or a target ratio of population per branch, below which expansion is unattractive. In contrast, underbanked regions, or areas where competitors lack key capabilities, like digital services or niche expertise, offer more promising entry points. Ultimately, a bank should weigh saturation against its unique value proposition. If it doesn't clearly differentiate, a saturated area may not justify the investment.
And that makes sense. Let's look more to the product side. So, say if the bank wanted an AI's help in identifying new potential product offerings, what would that process look like?
First, the bank would aggregate customer data, transaction history, inquiries, feedback, and demographic patterns. AI would identify unmet needs or emerging trends, such as demand for niche financial planning, ESG investments, or tailored credit products. The AI would then help prototype offerings by modeling potential uptake, profitability, and risk. The process would be iterative, testing hypotheses, refining features, and aligning products with customer segments. Ultimately, AI helps the bank move from intuition to data-driven product innovation, ensuring relevance and competitive advantage.
See, that right there is key, and I'm really impressed that the answer wasn't just this pedestrian version of, well, we would look at what you offer and compare it to what other banks offer. That's kind of the intuitive thing that she was referring to there, saying, well, we're doing A, B, and C. We don't offer D, but the Joneses offer D. Oftentimes, this is how the strategic thinking goes. But exactly what she was saying there is exactly right. You need to look at the underlying data and look and see what is the patterns within your data, within your demographics, and then figure out what products might align with those customer profiles based on their needs, combining external data as well. But I think that's exactly right. It's not just saying, well, we could do this product because we've never done this product. There has to be a reason to do this product. So I really like, where she was going with that. Are there any areas where it would be unwise for an institution to look to AI?
Yes, it's unwise to rely solely on AI for decisions that require human judgment, such as highly complex client relationships, nuanced ethical considerations, or sensitive dispute resolutions. AI can also be risky in areas where explainability is paramount, such as final credit denial decisions, where regulatory transparency is mandatory. Similarly, if data is biased or incomplete, AI can amplify inequalities. In essence, AI should augment, not replace human expertise in high stakes, opaque, or deeply personal contexts.
That's good. And finally, what question should I have asked that I didn't ask?
You might have asked about AI's limitations in banking, such as data privacy risks, model drift, or over-reliance on historical patterns in fast-changing economies. Another key question would be how to maintain human oversight, ensuring AI is used as a complement, not a crutch. Finally, you could ask how to foster a culture that embraces AI, ensuring both leadership and staff are equipped to work alongside it.
I sort of hate the fact that those have been really good questions. So this has been interesting. It's been fun. I've enjoyed this. And what I think my takeaway is that a lot of the responses we heard, if you're a seasoned banker, that stuff. I mean, again, that wouldn't have changed your world. But again, a lot of the questions that I've posed in this discussion was sort of high level as a starting place. But you could easily see where if you then took that same line of questioning and then layered in information about your specific institution, you could fine tune it and then go deeper around what would be the answer for our specific institution. And the good news is that, so much information is publicly available. So if you're in fact a public institution, most AI agents are going to be able to have information about your institution. They're certainly going to know everything about the demographics of where you are. and the areas around you, surrounding demographics. So, there's a lot of information that would already be available to an AI, and they just may want to provide it with some other specifics. Similarly, you could go down a path of looking at, providing certain information about your balance sheet, and then saying, hey, could you help us figure out some strategies around our balance sheet, strategies around how we could further balance maybe our interest rate exposure, and any area where, I want to understand more. I think for the risk people, that obviously opens up all kinds of interesting areas. I teased on that a bit and asking about a specific product, but I've done this several times where there was maybe a product offering or service area, even a business segment that I'm kind of familiar with, but I wouldn't consider myself an expert. And I've said, hey, tell me about this segment. What are the things I should be worried about? What should I be watching for? What are the kinds of things I should build policies around? How should I go about assessing my risks? And again, you're going to always, challenge everything the AI provides, but it gives you a great starting point for a lot of these areas that could really help strengthen how we do things. So, this is an evolving area, and obviously this was, again, one agent. This was using ChatGPT because I like having the vocal interface. I've heard really good things about Claude, Copilot, Grok, and there's some others that are evolving as well. And so it would be interesting to run those questions through some of those other models to see if they came up with different answers. So again, this was just designed to sort of give an example of what this would look like, and how I think you could do some really interesting things by asking for AI's input. And look, worst case, you don't know anything new, but on the chance that you do learn something new, or at least gives you new areas to think about, then it might be worth the time and investment. So I hope this was informative, or at least entertaining. So once again, thanks for watching.
The ERM Advantage Podcast is recorded at Lightshed Studios, Philadelphia, Pennsylvania. Copyright 2026 ERM Advantage LLC, all rights reserved. To inquire about appearing on the podcast, please contact us at info@ermadvantage.com.